Hey my friends, Dr. Barry Burns here with Top Dog Trading, and today I want to share with you the 7 deadly sins that you must avoid if you want to make money. Now I know that sounds like an ominous title, and dang, that background even looks ominous, doesn't it? I don't know where, where I found that, but that looks scary, a little goth. But I'll tell you what, even though that sounds negative, the truth is, if you avoid these, you're well on your way to enjoying eternal life as a trader. And there's so many traders who blow out their accounts, who continually lose money, not month after month, but year after year. And the intention of this presentation is to help avoid that for you so that you can prosper, make money, and enjoy a long, long life of profitable trading. And sometimes it's, actually, you know what? Someone once told me that successful trading is all about avoiding mistakes. And I have found that to be absolutely true in my life. Actually, I learned that from a poker player originally, a professional poker player in Las Vegas, who I happened to be there during the World Series of Poker, and just ran into this guy. Was a real nice guy, very charismatic, and we just got to talking, and he had done very well, made a truckload of money. And we started talking about it, and I said, I don't play poker, but I'm a trader. He says, you know what, they're very similar. And he said, you know, one of the main things is that the young guys are just not patient enough, and they make too many mistakes. And he said, if you just stick to your system and you're very, very patient, he said, that's what I do, is I outpatient these young guys. And that's very true of trading as well. So let's jump right into it and get into the 7 deadly sins and help you stop making these mistakes so that you can let the winners run. So here's deadly sin number 1. Thou shalt not trade choppy markets. And, you know, I'm sure you're aware of this. People are always complaining about the chop in the market. So the real question is, yes, you know that, but the how. How do I avoid choppy markets? Let me give you a couple of tips here that are very practical, and let's bring up some charts. So one of the first tips that I would provide for you is to put a 50-period simple moving average on your chart. It's interesting that so many traders I talk to, and I mention that to them, they always want to use a faster moving average. Even just take the 50 and make it a 50 exponential moving average. And I understand their intention behind that, but it's not well founded. They want to have something that's faster, that moves faster. Well, let me tell you. The way I trade is I use a combination of lagging and leading indicators. The reason for that is the lagging indicators, yeah, they are not timely, but they are more accurate because they accumulate more data before they give you a signal. The leading indicators, well, they are leading when they're right. The problem is they're not as accurate because they're using less information. So using the combination of the to provide signals like this. So if you look at what we have here, this is the line. I actually have it color-coded so it's green when it goes up, red when it goes down, black when it's sideways. And look what we've got here. This whole thing right here, this is a trendless market. This is what I would define as a choppy market, where the 50 MA is not committing to either direction, up or down. So it goes green, black, and you don't even have to have it color coded. If it's just kind of wiggling sideways, then that's a choppy market. What we want to see is a clear direction up or a clear direction down, where there's just no mistaking it. Never take a trade unless you have a very clear signal. So that's one thing to look for. The other thing to look for is when the market is not able to take a side. So the 50 MA I use as a line in the sand between a bull and bear market. So here it's above, here it's below. See how it breaks it? Then back above, then a little bit below, then above, then it comes back down below it again, then it goes back above, and then below. So it can never hold one side. That's what we want to see in a bullish market. We want to see it stay above the 50 MA. For a bearish market, we want to see it stay below the 50 MA. When it's above and below and above and below the 50 MA like this, then that is a choppy market, a directionless market, a chaotic market, and one that is not forming nice orderly patterns that have high probability trades. So that's one tip. Another tip I'll give you real quick here, since we don't have too much time, is to look at things like the advanced decline line and also the up-down volume for the market. So that works especially well if you're trading indexes, equity indexes, if they are flatlining for the day, it's not a very good day. The market has not chosen a clear direction for the day. So bring up those two indexes, have them on your charts. We use them as internal indicators, and another one you can use is the tick index. And if that's flat, if it doesn't hold one side of the market or another, again, it might be that way all day, and that might just not be a good trading day. Those are some ways to avoid chop. All right, deadly sin number 2, thou shalt not trade kamikazes. What are kamikazes? Well, that is a term coined by one of my former mentors. God rest his soul, he's passed on now. A great guy, and he coined this term, and boy was he ever right. And again, in now teaching myself and teaching other traders, I have learned what he learned, and that is that this is one of the most frequent things that traders do that kills their account. It is financial suicide. So let me show you what I mean by that. So his name was Ray, and what Ray meant by this was trading against the dominant direction of the market. And it's just suicide. What we want to do is the opposite. We want to trade in the direction of the dominant energy of the market. So, for example, if we look here, we see that, okay, the market topped out here, gets down below that 50 MA. There's our 50 MA. By the way, this black line is the 15 EMA. It retraces to it. That's exactly what we like to do, okay? It stays down. See how this stays down? All right, now let's look a little forward here. Let me show you what amateur traders do quite often. So they'll look at something like this, and they would say, oh, okay, well, we've been going down quite a bit now, right? All the way from here, all the way down to there. That's a long ways. And then they may look at, this is the stochastic indicator. Maybe they'll look at the stochastic indicator and say, oh my gosh, that is oversold. That's oversold. That's crazy. This thing can't go down any further. So first of all, 2 flaws there. Number one, it's not oversold. Just because a bounded indicator like stochastic hits the bottom does not mean it's oversold. It cannot go below 0 mathematically, so just because it goes to the bottom of the range does not mean it's oversold. As you see, it hits 0 right here, and yet, even despite that, the market continues to go down dramatically. So never call this oversold, never call this area overbought. That is not true. And it will mess up your trading because you're giving yourself this talk, this internal dialogue of what you would expect the market to do, which is not correct. This has no bearing on what the market's going to do. So they will be buying here. We have this, and I find it in myself too. I have found myself doing this, having this contrarian view that when the market's going down, I just want to buy it. I just feel like, yeah, I can't go down any further, especially when it gets kind of extended like this. And of course, you can already tell by the setup that I'm giving you here that it does go down further. It can always go down further and then say, okay, great, we had some support there. Well, now it's really gone down far. This is crazy. And I've actually been in trading chat rooms and listened to traders say, okay, average true range or, whatever envelopes they're using or indicators, and they just say it can't go down any further. And so they buy, and then the market kills them. It goes down dramatically. Look at that. Even though the market had already gone down further, now it kicks down and goes really strong down. What? That's just nuts. Okay, so let's buy here, because now this is ridiculously oversold, and nope, it still goes down further. So then we buy there. Well, you get the idea. Constantly buying against a dramatic move to the downside, or the converse, selling against a very bullish market, that's suicide. Don't do it. Always trade with the dominant energy of the market, never against it. All right, deadly sin number 3. So deadly sin number 3 is very, very important. Amateur traders often focus on setups and indicators and price patterns and that sort of thing. Professional traders, obviously we use those things too, but we are more focused on managing our money and managing risk. And that is one of the keys to trading and not blowing out your account, as I mentioned at the beginning of this video. We don't want you to blow out your account. So therefore, this becomes paramount. All right, let's talk a little bit about this and how I do this. So for this one, I don't need to bring up a chart actually. Let's just talk real quickly about the mathematics of it. So you're familiar with having a protective stop for your trade, and that's a good idea to have. I always have a protective stop for every one of my trades. So that's where it starts. So first of all, I personally won't risk more than 0.5% of my trading account on any one given trade. So that's where risk management begins. Then I go to, if I'm day trading, for example, then I'll go to the day and I'll have a protective stop for the day. And I will say something like, okay, for this day, perhaps I won't risk any more than 2% of my account. All right, now don't take these percentages literally. These are my numbers that I use. I'm not telling you what numbers you should use. And that would be my protective stop. So if I lose 2% of my account in a given day when I'm day trading, I'm just done. I'm done, and I literally close down my trading platform because it's too tempting to leave it open. Some people I know, they will go over to a simulator and keep trading on a simulator, and that's okay if you can discipline yourself to do that. For me personally, I just know myself, I need to just shut her down. And then I have a stop loss per week, and that stop loss per week is 4%. So you'll notice that 2% per day, but 4% per week? Wait, shouldn't it be 10% per week? Because 2 times 5 is 10? No, you want to tighten those stops up. It's almost like a trailing stop, if you will. Because if you're losing 2% every day, you're doing something wrong. You need to reel those numbers in. So for a week, it's 4% for me. Now, for a month, it's not 4 times 4%. No, it's 8%. So that's right, I got 4 weeks, but I'm going to, again, tighten that protective stop, if you will, down to 8%. And then you should have one for the quarter and one for the year, so that you can never, mathematically, it would be impossible for you to blow out your account as long as you're keeping those, very strict. And then that allows you to make sure you're not risking too much money. Now, obviously, if you're reaching those milestones, you're doing something wrong. Something's not good. So actually, if I did that, I would even just stop trading. I mean, I haven't had to worry about it for a long time, but if I did, and when I did, actually years ago, then I would actually just stop trading for a while, and I'd go to a simulator account, I'd review everything I did, and regroup, because that's telling you something's wrong. We want to be consistently profitable, not consistently not profitable. If you're being consistently not profitable, you shouldn't be trading. Okay, in number 4, again, we don't need any charts for this one. This is a very important one, though. Thou shalt not trade for the action. This is a hard one because we're traders. We love to trade. We want to trade. We want to execute trades. And the truth is, however, that high probability trade setups actually do not occur very often. Sorry, they just don't. Statistically, they don't occur as often as you or I would both like for them to do. You've heard of the book Random Walk Down Wall Street, I imagine. Great book, historic book actually, led to great conversations. And I can't go into all the details of the book, but I would agree that most of the time the market is a rather random walk, in the sense that it is, we're not able to predict what's going to happen in the future. Actually, I would say we can never predict what's going to happen in the future, but there are some times when we can establish a probability scenario that favors us, but those times are not very often. Therefore, sorry, I know you don't want to hear this. I don't want to hear it either, frankly, but I've learned this over 49 years of trading, that most of the time it's best to just keep your powder dry and sit on the sidelines. In fact, I think it was Van Tharp who said, good trading is boring. Not what we want to hear, but boy, if you want to make money, you better accept it and start trading that way and living for it. Learn how to deal with it. The mentor that I mentioned before, he used to watch tennis. He'd have tennis on. Tennis seemed to always be on when he was trading, and I traded with him in his house. Actually, in his girlfriend's house. He was in his 80s, and his girlfriend was like in her 50s, and just a great, great couple. And he'd watch tennis. And, people learn different psychological tricks and ways of doing this. You can set up audible alerts on your trading platform when things come together or get in the area of a potential high probability trade setup for you. But to sit there and just look at the charts and all day long without having anything to do becomes very psychologically challenging. So most people can't do it. Some can, but don't trade for the action. Trading is a business. It's not an extreme sport. Your objective is to increase your bottom line and not to take trades. Treat it like a business. Your job is to make profits, not have action. So if you want action, get an Xbox or get a some kind of video console. That's where you can play the action. But this is not a video game. Okay, let's move on to deadly sin number 5. Now, this is a big one, and again, this is one that I find a lot of people not truly understanding how the market works. This becomes a problem because, again, they're not being realistic about what trading really is, the realities of professional trading. So I call it thou shalt not worry about missing the boat. And what I mean by that is, traders will often look at the market and then they'll see that, actually there's two different aspects of this. Number one, that I hear most of the time, is people saying, oh my gosh, the market made this big move, but my trading method didn't give me a rule set that allowed me to get in on that big move. Therefore, my method sucks and I need to find a new one. And they're constantly shopping around for different trading methods, and they never settle in on one to really learn the intricacies of it, become so in tune with it that it becomes part of their nervous system. And that's what you've got to do. If you're shopping around for new trading methods all the time, you will never make money because any of them requires time and getting to get the feel for them. So if you're worried about, oh, the market made a move without me because my method didn't give me an entry, the rules didn't give me an entry to it, don't worry about it. That's okay. There's no method that's going to help you get into every big move in the market. There just isn't. In fact, not every big move is preceded by high probability setup. So again, we can't predict the future. Sometimes the markets just take off for good reasons, bad reasons, crazy reasons. Sometimes it's news, sometimes it's legitimate news, sometimes it's just a rumor or gossip. And you know what? How can a technical indicator get you in on that? So don't worry about the big moves. Don't worry about what the market does. Just focus on your method. A method that gives you high probability setups here and there. And those are the only ones that you need to concern yourself with. Don't worry about all the other moves in the market. Just let it do its thing. Whatever it's going to do, let it do. Let it be. Let it go. Okay? Because again, bottom line rule is not every move in the market is preceded by a high probability trade setup. People try to reverse engineer this. They'll look at, oh, the market moved without me. How could I have predicted that move is the question they ask themselves. And that's not a great question. You know, it might lead to something good, but I got to tell you, most of the time, it just leads to curve fitting. And you end up pull up a bunch of indicators, a bunch of stuff, and you find out, okay, if I would have seen this pattern on that indicator, you would have caught that big move. Well, guess what? That same indicator would not have helped you on the next big move or the next 5 big moves. So just find a method that works for you. Now, the other thing that comes into play here is when your rule set does give you a setup in catching a move in the market, but you missed it. And then you look at it, maybe you hesitated or maybe you weren't paying attention and you see it soon afterwards, and then it's real tempting to want to get in on that trade and to get in late. So the rules were there, but you got in late. Don't do it. Don't do it because you've messed up your risk-reward ratio. Now, if the market's already started to move in your direction, now your risk is going to be bigger and your reward is going to be smaller. So you missed it. Oh well, forgive yourself. No big deal. We're human. Just wait for the next setup. And now deadly sin number 6. Now we can get back to some charts here. Thou shalt not place stops too far. So what do I mean by that? Now let's look at some charts and I'll show you how So one of the hallmarks of a professional trader is that we keep our risk very, very small and our reward very, very big. So we want an excellent reward to risk ratio. Also like to have a good win-loss ratio, of course, but it's very important to have your winners be bigger than your losers. And again, we've all heard this. So how do we do that? Well, one of the ways we do it is by keeping our risk very small, technically. So here would be a setup bar. This is typical first retrace and the trend trade, very classic trade in the top dog trading methodology. And where do we put our stops? So first of all, the entry on this is 1 tick above the high of that bar. So if it's a stock, 1 penny above it. If it's Forex, it's 1 pip plus the spread above it. And in this case, this is futures, so it would be 1 tick above the high of that bar. And then the protective stop goes 1 tick below the low of that bar. So that is decided by the cycle indicator here, and momentum as well. Momentum is up, so it's a strong trend. First retrace in the new trend. So my risk is essentially that range, and that is typical risk of my trades. It's the range of 1 bar. Sometimes it's a bar and a half range. Okay, so that's it. That's the most that I will lose because I literally put my protective stop down there. Now let's put a little caveat in with that to be very clear and very transparent. Sometimes stops can be run, and stops you may not get filled to the price that you want, especially if whether you put in a limit or a market order, you may not either get the price you want or may not even get out, right? So another way of doing it is to make sure that you're hedging your positions with options. So when that stop gets hit, this is especially true of swing trading. If you're holding positions overnight, you're not day trading, I like to hedge my positions with options so that if my stop gets gapped through, I'm not going to get decimated by that overnight. So very important. It doesn't happen too often, but it's happened after 49 years of trading. It's happened more than once, and I've learned my lesson. Okay, so with that in mind, that's my risk. All right, so let's do it this way. I would like to do this very visually. So my risk is right there. Now, what's my reward? So on a trend trade, I expect the average trend to be 5 waves. So you can see we've got 1, 2, 3, 4, 5 there. So what's my reward? Well, my reward then is that. And there we go. So you can see very clearly now, risk is that, reward is that. Very, very important. Now, some people will use protective stops based on average true range, or Bollinger Bands or Keltner Bands or things like this. I'm not an advocate of that personally. I'm not saying that's a horrible way to do it. They do it because they feel that it gives them a little wiggle room for the noise of the market, and I understand that. Also, another good reason for doing it is, what if this turned into an ABC complex retrace, which actually it did, but what if the market went up here, came down, and went A, B, C, and then went up? So that's a reasonable reason to use an average true range stop. 2 problems. Number 1 is that the cycle indicator that I've created, this cycle indicator is very accurate, super accurate. So this, I rarely get stopped out in an ABC complex retrace because it's not the right time to enter the market on A when you get a complex retrace. So that just happens to be something that I have. By the way, I'm happy to share that with you if you'd like. I'll show you. And it's just so accurate that I don't have to worry about it. So I'm able to place my stops much closer than most people are. And the second reason that I don't like using average true range is I was talking with another professional trader, and he said, yeah, the algos now are actually targeting the average true range stops. There's algos that are literally programmed to take those out. So they may have been more effective in the past, but now with people actually targeting them, I don't want to be there. I don't want to be their bullseye. And finally, deadly sin number 7, the final one for today. And believe me, there's more than 7 deadly sins. I could go on and on. We human beings tend to make so many different mistakes. We have so many faults. But you know what? One of the keys I want to say here in closing is that, again, successful trading comes down to simply not making mistakes. So use your trading logs to keep track of your mistakes with every trade that you make. Write down any mistakes that you made. In fact, here's another little tip for you. Before you take a trade, ask yourself, if this trade doesn't work out, what would I write down on my trading log as to why it failed? Now, we always do, or we hopefully do that after we take the trades. We go through our trading logs, we analyze our trading at the end of the day, the week, the month, whatever. But here is what I'm saying, reverse it. Do that, but then also ask yourself that question before you take the trade. Again, the question is, if this trade fails, what would I write down on my trading log as to why it failed? And then, of course, ask yourself, well, now wait a minute. If that's a possibility, is that a real possibility or is that a remote possibility? And that might keep you out of some bad trades by actually saying, you know what? I was about to make a deadly sin here. I was about to commit one of the 7 deadly sins. Okay, so now let's finish up with deadly sin number 7. Thou shalt not take profits too soon. So this is a follow-up to the last one. Obviously, it's the reverse of the last one. We kind of covered it already a little bit, but I want to add a little more detail to it. So we saw this chart, and we saw the risk here and the reward ratio. Very good, right? Okay, so that's all obvious to us, and we're like, yep, that's what I want. Now, in real trading, here's what tends to happen. I mean, that's just great textbook kind of stuff. But here's what you're going to have to deal with in real trading. And this is why I say don't take profits too soon. So if we took this and we entered here, look what happened. The market went up to here. What it actually did was it went to this previous high, and it found some resistance there, which is typical. The market, the people in the market, the participants, they're saying, oh, yeah, that was where the market valued itself most expensively here just a little while ago, and therefore the market doesn't even have to have memory. Everybody's seeing that level. Don't have to have a long memory for that. That's short-term memory. And they're saying, okay, well, participants weren't willing to pay more than this in the recent past, so therefore they may not in the future, meaning now. And so the market hesitates. Okay, in other words, people aren't willing to buy. There's not as much buying. In fact, there might even be some shorting or some profit taking even. So then what happens is the market goes sideways for a little bit. And this is where you need to be patient. The reason for the trade was to get in early on a new trend. Wave 1, 2. That's the first retrace in a new trend. That's the earliest you can get in on a retrace in a new trend. And we're expecting it, the average trend is 5 waves. That's our expectation. So therefore, we've got to allow for the market to hesitate at resistance, wiggle around, go sideways for a little bit, and say, you know what, that's okay, that's normal, and I'm not going to freak out and jump out of this right away. Because if you do that, this happens all the time. And if you do that, then obviously you're not going to be able to take advantage of this major profit. The big profit here came on the other side of this sideways movement, of this hesitation, of this noise, of this chaos. So remember the reason for your trade, and as long as the reason for your trade has not been broken, then your trade should not be broken. That's the bottom line rule. So I hope you enjoyed this video, and more importantly, I hope that you profit from it. Again, my name is Dr. Barry Burns. I got a free offer for you, by the way, if you're interested. I've got a trading course that I'm going to give you for free for having finished this video. That's your reward. This trading course is called How to Make Money, Breaking Every Rule You Ever Learned. I know that sounds kind of strange, but it's really about how professionals trade differently than amateurs and why the old styles of technical analysis don't work anymore. Do you know that the Bible of technical analysis was written in the 1940s? Well, that was well before day trading and algos and high-frequency trading, flash trading, all that kind of stuff. With the advent of computers and all of the technology now, guess what? Markets move differently, and therefore chart patterns are different, and therefore you need to learn what works today. So that's what this course is about. It's just 5 short videos similar to this one. After each video, there's a little review to make sure that you really understood the information. And also, by the way, in there is one of my favorite trade setups. This is actually a trade that you can test on a simulator or demo account, and I trade this thing every day. The rubber band trade, it's called. And I love it. I find it very, very profitable. I've been trading it for years. So you can get it right there at that website. And it's my gift to you as my way of thanking you for watching this video. And again, I hope that you not only enjoyed it, but that it turns your trading around and helps you become more profitable. Oh, by the way, also, my email address is there at the top. If you have any questions about this presentation or anything else with your trading, feel free to email me. I love to correspond with traders, and I'd love to talk with you. Barry at topdogtrading.com.